Good. This is a free session courtesy of RCM Online College. So I want to handle a question under the concept of what we call variances. So when we are doing variances, you normally deal with three things. We normally deal with three things. So those who are doing advanced management accounting, this is covered under topic. This is covered under topic number 7. Those who are doing management accounting at intermediate level, this is covered under topic 10. Under topic 7, you call it budgeting and variances. Under topic 10 for management accounting students, you call it standard costing and variances, right? Good. So whichever level you are in, of course, you will be taught these variances. And what do we need to understand? So we have to get the variances in place. We have to talk about actual results. We have to talk about actual results, right? Then we look at actually variances comes last, right? We start with what we call standard cost, budgeted standard costs, right? So we will be given what we call a company needs to have its standard costs, right? So its standard cost card will be guiding the employees on how to do the production, what is supposed to be produced as per the standards of the company, right? Then once that is done, they are going to do now actual operation and look at the actual results. Yes, we budgeted to spend this amount of money on direct labor. What have we actually spent? That is now comparing standard costs and actual results. Now, should you find that standard cost is not equal to actual results, then it means you're talking about what we call variances, right? Good. Now, what normally happens is the examiner will always remove one from the question of these three items. The examiner will also always remove one of them. And the moment one is eliminated, you can use the two to get the missing figure. That is to say, the examiner can give you standard costs and actual results, then they eliminate variances. So the question will be, can you give us variances? Can you calculate all variances? And in most cases, if they give you these two and variances are eliminated, the third thing that you'll be told to do after getting the variances is what we call reconciliation statement. You'll be told to come up with a reconciliation statement of the standard cost cut and actual results, right? Good. Then another thing that the examiner can do alternatively, the examiner will decide to give you standard cost cuts or standard costs and variances. So you'll be told to give us actual results. Of course, this concept was tested in August 2024 for the advanced management accounting students. You are told to do what? To calculate all the actual results, right? Good. Then another way, the examiner can decide to give you actual results and variances. Then you are told to do what? To calculate the standard cost card. To calculate the standard costs. Good. If you are keen enough, the question that you want to handle here, the examiner gave out these two. The examiner went ahead and gave the students actual results and variances. So you have to come up with standard costs or standard cost or standard cost card. That is what we have. Great. So are we together? Do we now have the question? Confirm whether you have the question with you. Confirm whether you have the question with you. Confirm. Do you now have the question with you? Before we get into the question to solve each and every item given there, do you have the question with you? Do you have the question with you? Please confirm. Please confirm. Good. If not, those who have just joined, I'll reshared for their interest. For their benefit, I'll be able to reshared. Great. So let's go to the question and see. We are being told that Plasma's TV Limited makes smart TV or television sets. The company operates a standard absorption costing system. right? So absorption costing system is whereby the fixed production costs are forming part of product cost. The fixed production expenses are forming part of product cost. Great. Then we are being told that the following data has been collected for the year ended 30th November 2024. So we are given actual costs incurred. We have direct material. They used 165,000 kgs, and the amount spent was 15,675,000. So that is direct material. Then we have direct labor. They utilized 80,000 labor hours, which costed this company 5,800,000. Then we have variable production overheads that were incurred is equal to 16,800,000. Then of course we have the last one, fixed production overheads. Fixed production overheads, right, of 6,750,000. Good. So let's go to the next part. The variance reconciliation statement was prepared to investigate the main cause of difference between budgeted profit and actual profit. The following planning and operating variances were disclosed from the analysis. Good. So number one, we are given favorable and adverse. The difference between favorable and adverse variance is that favorable, you are having a positive variance. You've spent less than what you budgeted. Then adverse, you've exceeded what you budgeted for in terms of expenditure. And of course, in terms of quantity, when we'll be dealing with the raw material, in terms of hours, when we'll be dealing with labor hours. Great. Now, so we have all the variances given there. That is direct material price variance, direct material usage variance, direct labor rate variance. Remember, you cannot purchase labor and keep it somewhere. No, what you normally do, you pay for the labor, the services that were offered by the laborer, right? So now this is why we are not talking about labor price variance, but it is labor rate, because it is charged based on the hours that someone has spent on the job. Good. Then we have direct labor efficiency variance. How effective are you utilizing your labor hours, right? Because under this, you'll be able to know you are paying somebody for 8 hours in a day, but actually they are not doing the 8 hours. They are doing barely a maximum of 4 hours. Why? Because when they get to the office in the morning, they have to greet everyone for like an hour. So they'll be taking 1 hour to greet everyone in all the departments, 1 hour. Then they also need to now have their working station ready for the work. They take another 30 minutes to settle. They'll be doing that work actively for 2 hours, leave for lunch break. Their lunch break, they'll be leaving at maybe 10 minutes to time, but they'll be coming back 2 hours later. If they have to leave work at 5, by 4, they have switched off everything. They're waiting for 5 so that they can leave. So if you actually pay 8 hours, then this 8 hours is not used in the production. This 8 hours, part of it is wasted, right? Part of it is wasted. So that is what you're going to see under labor efficiency variance. So additional information. Variable production overheads are absorbed based on actual hours worked. There was no significant difference in opening and closing work in progress. So in short, there's no opening or closing work in progress. Actual production was 1,500 television set units for the year ended 30th November 2024, right? So required, number one, calculate the following: standard material cost per unit. Number two, standard labor cost per unit. Number three, standard variable overhead absorption rate per unit. Number four, standard fixed overhead absorption rate per unit. Standard fixed overhead absorption rate per unit. Great. So of course, what I wanted you to do here, they will have summarized it and said, can you please prepare what we call standard cost cut, come up with what we call standard cost cut. So this is what you are supposed to. Of course, they have decided to separate it. They have decided to separate the components of what they want you to do. But basically, if you bring all this together, what you are getting is called standard cost cut. So let's start with the first part. Without even looking at this, we'll automatically be able to identify that by the end of this session, we have all these items that you are required to have down here. Nice. So let's start with the first part. Which variance are we given? The first variance given to us is direct material price variance, right? So this is what we are going to do. We are going to write the formula and then use the formula to solve the missing figures. So let's start with the material. Let's start with the material. Material price variance. Good. So how do we calculate material price variance? Material price variance. Material price variance. Material price variance. Material price variance is equal to standard price minus actual price, right? Standard price minus actual price. Then the results you multiply by what we call actual quantity. Material price is equal to standard price minus actual price. Then you multiply by standard quantity, actual quantity. Good. So do we have any of these three items? What we have been given is the variances. So what do we have? We have material price variance. Our material price variance is a favorable one. That is a positive price variance. So is equal to 825,000, right? Material price variance is equal to, open your bracket, standard price. Are we given standard price? Are we given standard price? The answer is no. That is what we are required to do. What? That is what we are required to calculate. So how do I get, so we're talking about standard price minus actual price. Are we given actual price anywhere? Or is there any item given to us that can be used to calculate the actual price? Do we have actual price somewhere? Do we have actual price? Under which part will we be able to get actual price? Good. So if you look at our actual cost in CAT, we already have actual quantity and we have actual material cost. So what do we need? Actual price. How do we get actual price? Using this data here. How do we get actual price? Our actual price will be total cost divided by total quantity used. So that will give us actual price, which is 15,675,000. We divide by 165,000. So that will give us what we call actual price. Then to that actual price, we need to multiply by actual quantity, which is 165,000 kgs. 165,000 kgs. Good. So what are we getting? What are we getting? Somebody to give us the first figure. At least we know whether we are moving together or not. Good. So let's deal with the first part. The missing item or the unknown item is this standard price. So let's make standard price the subject of the formula. Let's make standard price the subject of the formula. So how do I make it the subject of the formula? Great. So I'll come to this part and say what is outside the bracket multiplied by what is inside the bracket. So let's start with the first one. This bracket here, we have standard price multiplied by actual quantity. So that will be 165. So 825,000 is equal to 165,000 standard price minus 15,675,000 divide by 165,000, multiply by the same 165,000. What are you getting? What are you getting? If you deal with it that way, what are you getting? Right? So let's extract this part only, this part. Let me just put somewhere there to someone to be able to see, right? So we have, we are being taught it is 15,675,000 divided by 16 or 165,000, then multiply by 165,000. So what are you getting? If I do that, what are you getting? Are you getting 15,67,500? 16 or 1567? Are you getting that? Are you getting that? Are you getting the same figure? Are you getting the same figure? Great. So that is what we need to bring here. That is 15,675,000. 16 million or 15,675,000. Good. So can we now make standard price the subject of the formula? Collect like terms. So 165,000 standard price is equal to, now this is a minus. If it crosses the equal sign, it will be a plus, right? If it crosses the equal sign, it will be a plus. So let me see. That is 15,675,000. We now add to what we call 825,000. So that will give us a total of 16,500,000. Right? So that is 16,500,000. Great. So let's go ahead and divide both sides by this to give us standard price. What will be your standard price? What will be your standard price? It will be 16,500,000 divided by 165,000. So let me see what these great people are getting. What are you getting? Is it 10 or 100? 16,500,000 divided by 165,000. Is it 100 or 10 shillings? Is it 100 or 10 shillings? Let's see it together. So when I do this, I'll be getting 100 shillings, right? So standard price will be 100 shillings per kg of direct material. Nice. Good. So let's go to the next thing. From material price variance, we need to get what we call material usage. So how do we get material usage variance? How do we get material usage variance? Material usage variance is equal to standard quantity in actual production. Standard quantity in actual production minus actual quantity. Then you multiply by standard price. Good. So material usage is the standard quantity in actual production. We multiply by, or we less actual quantity, then multiply by the standard price. I want you to go to the question under variances. What is our material usage variance? Please post the figure down there. Write the figure down there. What is our material usage variance? Direct material usage variance. What is the figure? What is the figure for our direct material usage variance? It is adverse. It is adverse. It is a negative, right? So it's a negative of 1,500,000. Good. So this is what you are going to do. A negative of 1,500,000 is equal to, open your bracket, standard quantity in actual production. So we do not have that standard quantity in actual production. All right. So standard quantity in actual production. Then we less actual quantity. Do we have actual quantity? Yes, we have actual quantity of direct material used. That is 165,000. Then we multiply. We multiply by something. We multiply by something. What is this something? Standard price. And of course, we now have standard price up here. So just take that, multiply by 100. Great. That's our first step. That's our first step. That's our first step. Having done that, we now go ahead and collect the like terms or break the bracket. So a negative of 1,500,000, a negative of 1,500,000 will be equal to, let's now break the bracket. 100 by standard quantity in actual production will be 100 standard quantity in actual production, right? Then minus 165,000 by 100. 165,000 by 100 will give us 16,500,000. Great. That is what we are having. So we have been able to break the bracket. We have been able to break the bracket. Nice. So let's now collect like terms. After breaking the bracket, we now collect the like terms, right? So we now have 100 standard quantity in actual production, right? 100 standard quantity in actual production is equal to, this is a minus. If it crosses the equal sign, it will be a plus. But of course, 1,500 or 1.5 is a negative. So it will remain that way. Good. So what do I need to do? I'll now convert this to be a positive because it is crossing the equal sign. Then I retain negative 1,500,000. Good. So that will give me something. What is that something? I want us to get standard quantity. Standard quantity in actual production. Standard quantity in actual production. Standard quantity in actual production. Good. Someone is already having the answer. Thank you. Someone is already having the answer. So for us to get standard quantity in actual production, we divide both sides by 100. So in short, it should be 16,500,000 minus 1,500,000. Then the whole of that, you can see it here. The whole of this, we divide by 100. We divide by 100. If I do the same, I'll be getting 150,000. That is the standard quantity in actual production, right? Good. Can you now give me actual production? What is our actual production? Was it given anywhere? Was it given anywhere? If yes, please mention that additional information. Actual production, we are talking about the television set. So go to the question under additional information or anywhere. Do we have something talking about actual production? If yes, which additional information or how many units? Which additional information or how many units? Good. So actual production was given under additional information number 3. Actual production was 1,500 television set units, right? So we have 1,500 television sets. Good. Now, can we get standard quantity per television set? Can we now get standard quantity per television? Can we now get standard quantity? It will be standard quantity in actual production divided by the units produced, that is 1,500. So it means our standard quantity per television set is equal to 100. Standard quantity per television set is equal to 100 kgs. Is equal to 100 kgs. 100 kgs. Good. So are we together up to that point? Are we together? Are we together? Are we together? Confirm that. Great. So let's go to labor, right? Our next variance here is what we call direct labor rate variance. So let's look at labor. Let's look at labor rate variance. That we said, labor, you don't purchase whoever is offering the service, but you pay for the services offered, right? So we talk about labor rate, not labor price, right? So how do we get labor rate variance? Labor rate variance is equal to standard rate minus actual rate, standard rate minus actual rate. Then we multiply by actual hours. Labor rate variance is equal to standard labor rate minus actual labor rate. Then we multiply by actual hours. Remember, it is rate per unit. I mean, per hour. It is labor rate per hour. But of course, when you now dive into this, when you go into details, when you now meet in class, we'll be able to see a lot of things. Number one, we'll be able to see another part of this question whereby you are not, or you are given maybe more than 2 labor hours, more than 5 labor hours to be used in producing 1 unit. So how do I deal with the rate at that point? Remember, the rate is per cost driver, and the cost driver is labor hours. So it's standard rate per labor hour. Nice. So let's go ahead and replace this. Are we given labor rate variance? That's what I want you to type there and indicate, if possible, is it negative or positive? Labor rate variance, labor rate variance. Labor rate variance, please locate it there. Labor rate variance. Is it positive or negative? Indicate that. Good. So our labor rate variance is an adverse figure. That is negative 200, negative 200,000. Good. So we come to this part and say negative 200,000, negative 200,000 is equal to, negative 200,000 is equal to, number one, standard rate. We don't have standard rate. That is what we are looking for, minus actual rate. How do we get actual rate? Do we have actual rate within the question? Do we have actual rate? Yes, we can get that actual rate. Why? Because we have actual results. We have actual labor cost and actual labor hours. If we divide the two, we'll be able to get what we call the actual rate. So it is 5,800,000. We divide by 80,000. We divide by 80,000. So that section will give us what we call actual rate. It will give us actual rate. Then to that actual rate, we need to multiply it by actual labor hours. What is our actual labor hours? Our actual labor hours is equal to 80,000. So this is what we need to solve to get this unknown standard rate. That's what we need to solve to get the unknown standard rate. Great. So let's proceed. Let's proceed. So when I come to this part, I'm required to break the bracket. That should be my first step. I'm required to break the bracket. So 200,000 is equal to, when you break the bracket, standard rate multiplied by 80,000, it will be 80,000 standard rate. Then I less, so 5,800,000 divided by 80,000 will give me actual rate per unit. Then actual rate I multiply by actual hours. Actual rate per hour multiplied by the hours. If I divide by 80,000, then I multiply by the same 80,000. Automatically, 80,000 will cancel out, and I remain with 5,800,000. Right? Good. That is what I'm having. So my next step is to collect like terms, right? So I'm able to see I have 80,000 standard rate being equal to, I have negative 200,000. I have this negative. So if I have to retain the standard rate to be in positive form, this one, this will cross the equal sign to be a positive 5,800,000. The 200,000 is still on the same side, so it is retaining that negative 200,000. Great. Please go ahead and now give me the standard rate. What is our standard rate? Our standard rate will be equal to 5,800,000 less 200,000. The whole of that I divide by this figure that is here on the standard rate figure, that is 80,000. I want to see the first person who will give us the right answer. What is your standard rate? What is your standard rate? Standard rate, standard rate. What are you getting as the standard rate? Great. So I'm being told that the standard rate is 70 shillings per labor hour. Are we all getting that? Are the rest getting the same? Please confirm, confirm, confirm. Are the rest getting the same? Nice. So let's compare. Let me also see what I'm having here. So I'm getting 70 shillings per direct labor hour. Good. Now, even though we've been able to get the labor rate variance, someone or standard labor rate, we want to look at, is this company really paying for the labor that is utilized to do production, or we have that type who goes for lunch like 3 hours. We have that type who closes their work at 4 and wait for 5. Let's see how this company is dealing with that problem. So let's now move to the next part called labor efficiency variance. Labor efficiency variance. How effective is this company utilizing the labor hours paid for? How effective is the company utilizing the labor hours paid for? So labor efficiency variance will be equal to, right? Remember, when you are getting, okay, the labor efficiency variance will be how effective. So we're talking about standard hours in actual production. Standard hours in actual production will less standard hours in actual production will less actual hours will less actual hours, then we multiply by the standard rate. Great. Now, let's collect the like terms or start with what is missing and what is available. Can you please post down there labor efficiency variance? And if possible, indicate whether it is adverse or favorable. Labor efficiency variance. Labor efficiency variance. Labor efficiency variance. Labor efficiency variance. Good. So Fred is telling us here that labor efficiency variance is negative 350,000. To mean it is adverse. Negative 350,000. Great. So let's get the figure. So our labor efficiency variance, that is the adverse 350,000, is equal to standard hours in actual production. Standard hours in actual production minus actual hours. So how do we get actual hours? Actual hours, do we have actual hours? Yes. Remember, we were given direct labor hours. And why are we using direct labor hours? Additional information number 1. The variable production overheads are absorbed based on actual hours worked. So let's get actual hours. actual hours is equal to 80,000. Then we divide by the standard rate. And what was the standard rate? I mean actual rate. See, standard rate, we have our standard rate already, is calculated up here. So let's use the standard rate of what? Of 70. That is the standard rate. So let's go ahead and thank you, it is 70. Let's go ahead and get these standard hours in actual production. So let's break the bracket. Let's break the bracket. Let's break the bracket. Good. Let's break the bracket. So we have 350,000 is equal to, when you break the bracket, it will be 70 standard hours in actual production, standard hours in actual production minus, so 80,000 by 70. What are you getting? 80,000 by 70. 80,000 by 70. 80,000 by 70. That should be 5,600,000. So we've been able to break the bracket, right? Good. So let's collect the like terms. This is a minus. If it crosses the equal sign, it will be a plus. That is a minus. If it crosses the equal sign, it will be a plus, right? It will be a plus. Now, can we now make standard hours? Standard hours. So 70 standard hours in actual production, 70 standard hours in actual production is equal to, now this will be a plus when it crosses the equal sign, 5,600 or 5,600,000. Then now this will retain the negative sign. It will retain the negative sign. Good. So let's now get our standard hours in actual production. Standard hours in actual production. What do we have? So it'll be talking about 5,600,000 minus 350,000. Then we divide by 70. Please give me your standard hours in actual production. Your standard hours in actual production. Good. Somebody is telling me it's supposed to be 75,000. Supposed to be 75,000. Great. Now that is standard hours in actual production. Can we get standard hours per unit? Standard hours. So we have standard hours. Standard hours per unit. Standard hours per unit is equal to the standard hours in actual production divided by actual units produced. So that will give us 50. That will give us 50 hours. Are we getting the same thing? 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 Please confirm. Repeat. Okay, which section? Nice. Are we okay up to this point? Are we okay up to this part? Let's maybe pick it from this point. Are you okay with this part? Are we okay with the 70 standard hours? Nice, nice, nice. So we've been able to see where the problem is. So when you have 70 standard hours in actual production, let's first of all deal with this side of the bracket, right? So that side of the bracket, we are talking about 5,600,000 minus 350,000, right? So that will give us 5,250,000. Now, that one is equivalent to 70 standard hours in actual production. If you want to get standard hours in actual production, standard hours in actual production, standard hours in actual production, what do we need to do? What do we need to do? If you want to get standard hours in actual production, if you want to get standard hours, not in 70 actual production, no, standard hours on its own in actual production, we'll now be talking about this amount. We divide by that 70, then it is giving us 75,000. How do we get standard hours per unit? Standard hours per unit, it will be the standard hours of 75,000, right? This actual production, how many units were actually produced? So it is 75,000 when 1,500 units were produced. What is the standard hours per unit? That is why we're now taking 75,000, we divide by units produced. Then it is giving us 50 hours per unit. Is it now clear? Is it now clear? Nice. Let's move to the next part, the overheads. Let's start with what we call variable. Variable overhead. Variable overhead expenditure. Variable overhead expenditure variance. So what we need to understand about variable overhead expenditure variance, it is very simple. We have two methods to deal with this. So variable overhead expenditure variance is equal to budgeted variable overhead minus actual variable overhead, right? How do we get budgeted variable overhead? Budgeted variable overhead is equal to variable overhead absorption rate, then we multiply by actual activity level. And actual activity level in this case is actual labor hours. We multiply by what we call actual labor hours. Good. So actual variable overhead, we automatically will be given that. Our main interest here is to get variable overhead absorption rate. Another name of variable overhead absorption rate is the standard rate. Is the standard rate, right? That is method one. Method two, variable overhead expenditure variance is equal to standard rate minus actual rate. Then we multiply by standard rates minus actual rate, then you multiply by actual hours. Good. So let's see if these two methods will give us the same thing. Let's start with the first one. Budgeted variable overhead is equal to variable overhead absorption rate times actual labor hours. But because we don't have that, what we currently have is the variable overhead expenditure variance. So what is our variable overhead expenditure variance? What is our variable overhead expenditure variance? I need to go to this place, variable overhead expenditure variance. Variable overhead an advance of 800,000, right? Good. So we'll come to this part and talk about advance of 800,000 is equal to budgeted variable overhead, which we do not have, minus actual variable overhead. So if you go to the actual results, what is your variable overhead? Our actual variable production overhead is 16,800,000. Is 16,800,000. Great. That is what we are having. That is what we are having. Oh, because of the negative sign. Good. Now, can we get this missing figure? budgeted variable overhead. So budgeted variable overhead should be equal to, make it the subject of the formula. Our budgeted variable overhead will be equal to, so this will be crossing the equal sign to be a plus on the other side. So 16,800,000 minus 800,000. What is your budgeted variable overhead? Budgeted variable overhead is equal to how much? Budgeted variable overhead. Budgeted variable overhead is equal to 16 million, right? Good. So having gotten that, we now need to get, our main interest is to get the standard rate, standard absorption rate, which is called variable overhead absorption rate, right? Good. So can we now go ahead and get our budgeted variable overhead? The formula is here. So we now drop this formula. We now drop this formula down here. Budgeted variable overhead, that is 16 million. 16 million is equal to variable overhead absorption rate. That variable overhead absorption rate, we multiply by actual labor hours. What is our actual labor hours? What was the actual labor hours? Go to the statement. Actual labor hours, we have it somewhere under actual results. What is our actual labor hours? What is our actual labor hours? Somebody to help us get the actual labor hours. It is something that we are able to see. All of us should be able to see it. Actual labor hours. Are the rest able to see the actual labor hours under this table? Our actual labor hours is equal to 80, is equal to 80,000. So we multiply by 80,000. We multiply by 80. We multiply by 80,000. Great. So if that is done, we should be able to get variable overhead absorption rate. So variable overhead absorption rate is equal to, of course, you can see we need to get this unknown. So divide both sides by 80. 16 million divided by 80,000. Divided by 80,000. That will give us 200 shillings. So this variable overhead absorption rate is the same as standard rate for the variable overhead. Can we use this other approach to get the same thing? Can we use this other approach to get the same thing? The answer is yes. So variable overhead absorption rate is equal to, right? Variable overhead, expenditure variance is equal to the standard rate, which we do not have. Standard rate minus actual rate. Do we have actual rate? Actual rate is the actual variable overheads, which is 16,800,000. We divide by actual labor hours, which is 80,000, right? So that will give us the standard, the actual rate. That will give us the actual rate. Then we multiply by actual labor hours, which is 80,000, which is 80,000. Great. So let's now solve this. Let's break the bracket. So variable overhead expenditure variance, I was told, is equal to negative 800,000, negative 800,000. Then we equate to standard rate, which we do not have. So standard rate times, we are now breaking the bracket by multiplying by what is out. So we have 80,000 standard rate minus 16,800,000 divided by 80,000 times 80,000 is still giving us the same figure. Good. So the bracket, we've now been able to break the bracket. So we collect like terms. We have 80,000 SR, 800,000 negative. So 80,000 standard rate will be equal to 16,800,000 minus 800,000, right? So if I do that, my standard rate should be equal to 16 million, right? 16 million. Then I divide by 80,000, which is together with SR. Good. So you can see our first method is giving us 200. Our second method is giving us 200. And of course, our standard rate here is the same as variable overhead absorption rate. Variable overhead absorption rate. Are we together up to that point? Are we together? Are we together? Someone to confirm. Are we together? Nice. We're remaining with the last one, that is fixed overheads. Fixed overheads. Fixed overheads. Good. Or even variable overhead efficiency variance. So the variable overhead efficiency variance, it will take us to the same. We are going to have the same standard. We are going to have the same standard rate. That is 200 shillings per direct labor hour. Good. So let's go to fixed overhead expenditure variance. Fixed overhead expenditure variance, right? So fixed overhead expenditure variance, fixed overhead expenditure variance is equal to, fixed overhead expenditure variance is equal to budgeted fixed overhead minus actual fixed overheads, right? Good. So how do we get budgeted fixed overheads? We first of all need to get it from this part. So do we have fixed overhead expenditure variance? Fixed overhead expenditure variance, fixed production overheads expenditure variance is equal to 1250, is equal to positive 1250,000 equal to budgeted fixed overhead minus actual fixed overheads. Do we have actual fixed overheads? Yes, and the actual results, our actual fixed overheads is 6750,000. 6750,000. Good. So let's get the missing figure, that is budgeted fixed overhead. Budgeted fixed overhead, we make it the subject of the formula. So we have, these are negative. If it crosses the equal sign, it will be a plus. It will be a plus. It will be a plus. So that gives us 8 million. That gives us 8 million. Good. So we have another formula of getting budgeted fixed overheads. Budgeted fixed overheads is equal to fixed overhead absorption rate multiplied by actual activity level. In this case, that actual activity level is actual labor hours. Actual labor hours. So let's go ahead. So our budgeted fixed overhead, that is 8 million, is equal to fixed overhead absorption rate multiplied by 80,000. That is the actual labor hours. So can we get fixed overhead absorption rate? So our fixed overhead absorption rate will be equal to, we divide, right? Because 80,000 by this will be 80,000 fixed overhead absorption rate. Divide by 8 million. So 8 million divide by 80,000. What are we getting? Fixed overhead absorption rate per labor hour, right? It's the same as the standard rate for the fixed overheads per hour, because they're subjected to the hours, per labor hour, per labor hour. That is what we have. Now, once you have that in place, look at how coming up with a standard cost card is very, very simple. Our standard cost card, we need direct material. Direct material. So my first question is, what was our standard price for direct material? What was our standard price for direct material? Direct material. The standard price is 100. Standard quantity per television is 100. So direct material will be 100 kgs at shillings. 100 kgs at shillings at 100. Right? 100 kgs at 100. Then we have direct labor. Direct labor. We're talking about standard hours. So standard rate is 70. Standard hours per unit is 50. So we're talking about 50 hours at shillings. 70 per labor hour. At 70 shillings per hour. Right? So when I deal with these two, of course, we are told we have variable overheads. Variable overheads. So variable overheads, what are we talking about here? We are talking about the standard hours will be retained, right? So standard, that is 50 hours. At what rate? At shillings. At shillings, what was the standard? What was the standard? What was the standard for the variable overhead? We have it here. So standard rate was 200 shillings per direct labor hour. Then we go to the fixed production overheads. Fixed overheads. So fixed overheads, we are still dealing with the 50 hours because these things are subjected to the labor hours. At what rate? At shillings. At shillings for the fixed production overheads, right? The fixed production overheads was this rate, 100 shillings. So we come to this part and talk about 100 shillings per direct labor hour. Direct labor hours is this one at shillings. At shillings 70 per hour. Good. So with that, we should be able to get what we call production cost. So this part we are having equal to 100, we multiply by 100. Then this one is equal to 50, we multiply by 70. Then this one is equal to 50, we multiply by 200. Then this one here is equal to 50, we multiply by 100. Then we get the summation, right? So we add everything there. So that is the standard production cost. Standard production cost. So if you are told to give us standard production cost of 1 unit of television set. Standard production cost of 1 unit of television set. Then this is what you are supposed to do. So this is what you are required to do. But now the examiner divided this into 4. You are required to give us direct material cost, the standard material cost, right? You are told to give us the standard material cost. You are told to give us the standard labor cost, standard variable overheads cost, standard fixed overheads, right? So what we have been able to post there is this one here. Standard material cost per unit, standard labor cost per unit, standard variable overhead absorption rate per unit, standard fixed overhead absorption rate per unit. Great. So that is what you are required. That is what you are required to come up with. That is what you are required to come up with. Good. Are we together up to this point? Are we together? Are we together? Have you been able to learn something? Have you been able to learn something? Great. So those who have not joined our classes, this is the right time. You can clearly see what has happened. You can clearly see what is ahead of us. And of course, you still have enough time to be able to catch up and join your friends. So the packages are provided down here. For this particular unit, that is Advanced Management Accounting or Management Accounting class, you will be getting to the class by paying 4,800 for the entire semester, and you'll be able to access all the videos. If you want to pay for any other unit, of course, you indicate the unit name as the account number. Here is the pay bill, right? Here is the pay bill. So this pay bill will assist you to be able to do your payment. Will assist you to be able to do your payment. So account number, you indicate the unit name. Is it Advanced Management Accounting plus AFM AAA or another unit, or is it Management Accounting, FR, right, and company law? So indicate the units there, and then you do your payment. If you want to do any inquiry before you do the payment, then reach out to these two numbers. They'll be able to assist you. If you want to do any inquiry before you do the payment for the classes, then reach out to these two numbers. Somebody is now wondering, if I join us at now, these people have learned for some time, for maybe 2 or 3 weeks ago. What will I do? You'll be able to access all those classes that were done when you are not there at zero extra cost. The moment you pay your 4,800, you are entitled to access those classes that were done when you are not there. So that is the advantage of actually joining as early as today. Good. So that will be shared to you the moment you get to the class. The moment you get to the class, it will be shared to you. But if you've been able to join the class, then reach out to 07 94 78 0000. He will be able to assist you. He will be able to assist you under that procedure. So I believe that was enough. That was educative, and therefore we have to end our session on this particular point. So thanks for your time and have a blessed afternoon.